Hello and welcome to the Global View on this Thursday. Let's get across what's going on a macro level. US producer prices increasing more than expected 0.5% in September amid higher energy costs, but underlying inflation pressures eased. Core PPI, which strips out food and energy, increased 2.8% on an annual basis after climbing 2.9% in August. Tomorrow, though, the focus will be on September's consumer price data and how the Fed will respond against the backdrop of rising US Treasury yields and conflict in the Middle East. Meanwhile, minutes from the Fed's last policy meeting reveal uncertainty around the path of the US economy, potential oil price shocks, and the impact of union strikes, which pushed Fed officials into a cautious stance, saying it supports the case for proceeding carefully in determining the extent of additional policy firming that may be appropriate, noting that the risks had become more two-sided. Well, there was little reaction to the Fed minutes from the yield on the 10-year Treasury note, having earlier fallen to a two-week low on safe haven flows as fighting intensifies in the Middle East. The two-year yield rose just above 5%. And Federal Reserve Governor Michelle Bowman has said that despite some progress on inflation, the US Central Bank will probably need to tighten monetary policy further, given the pace of spending and a tight jobs market, saying this suggests that the policy rate may need to rise further and stay restrictive for some time to return inflation to the FOMC's goal. While Fed Governor Christopher Waller has said the central bank is in a position to watch and see what happens with interest rates, with tightening conditions in financial markets poised to do some of the work for us. Well, the US dollar did slide after that hotter than expected data on US producer prices, showing underlying inflation though moderated further in September. The Aussie dollar currently trading at 64.1 US cents. Now, it hasn't been a pretty market debut for Birkenstock. It's ended more than 12% below its initial public offering price in an underwhelming Wall Street debut that signalled investors remain cautious about new listings. Shares of the 250-year-old German sandal maker began trading at $41 after the IPO had priced it at $46. That offering raised $1.48 billion, priced at the midpoint of that indicated range there. And the public reaction, well, somewhat amusing there. The opening there is uglier than the shoes, and that is saying a lot. Yes, maybe you have to be a devotee of those peculiar-looking sandals to actually appreciate that, or even buy into the stock at this point too. All right, well, given the economic weakness we're seeing in China at the moment, does that give India the potential to replace China as an engine of global growth? Well, Arthur Budyaghyan, the chief strategist for emerging markets at BCA Research, gives us his view.
Hearing that the government is considering to issue 1 trillion RMB special bonds and direct that funding for infrastructure. And I think it's a reasonable thing to do at this point, because central government has instructed all local governments to issue special bonds, entire target for 2023 by end of September. So Q4, we have an empty quarter. So if government doesn't do it, we're going to have basically a little funding for infrastructure project. So it's critical for government to fill this air pocket of Q4. And on average, in the past 2 years, quarterly issuance has been about 1 trillion. And I think those rumors are credible, so it's coming. So it's something that makes sense to do.
Okay, but overall, does this alter the picture as far as economic growth in China is concerned in terms of generating some sort of recovery there?
No, I doubt it's going to be a game changer. Yeah, it's going to put a floor on the growth. I think that's how to think about it, putting floor on the growth, but not creating a cyclical recovery.
All right, so overall, where do you see this, particularly as far as, I guess, we put this in the global picture as far as demand for Chinese exports, and what are you seeing there in terms of that picture and how that's likely to affect particularly the yuan?
I think Chinese exports will continue contracting, which is consistent with continuous contraction in global trade. Pace of contraction might moderate because we're entering second year of contraction. Again, something that has fallen already 10, 12%, it doesn't have a chance to fall another double digit this year. So I think pace of contraction in Chinese and overall Asian exports will moderate, but it still will be contracting at single digit rate. And the reason that Europe is already moving into recession, domestic demand in Europe seems to be contracting based on leading indicators, and tightening of monetary conditions in US, high interest rate will probably have a eventual hit the consumer spending in US. I don't think it's imminent, but something in early 2024, that's something to expect.
All right, so as a result, what are you seeing just in terms of profitability for Chinese companies and those likely valuations?
I think we should separate profitability for export sector and profitability for listed companies, because not many export companies are listed. If we're talking about export companies, their profitability has been cushioned by falling RMB. As RMB has depreciated, export prices, even though they are falling, deflating in US dollar terms, for Chinese producer, export prices are rising in RMB terms, local currency terms, what matters for their profitability by and large. And if we look at profitability of listed companies, I think that's a very different picture. There is a widespread deflation in China, and when you have a widespread deflation in economy, profits are going to be quite weak, in fact, contracting. So I expect kind of very weak profit picture in China to persist.
Overall, given historically, of course, China's been operating current account surpluses, how has that affected GDP growth?
Mathematically, a current account surplus, it's adding to GDP. So larger current account surplus, it's positive for GDP. So by China running current account surpluses, it has been boosting GDP numbers in China in the past 20, 25 years.
All right, so we're going to make the comparison here between China and India, with perhaps the potential for, well, some looking for India to replace China as that engine growth for the global economy. What do you see? What contribution does India have to the global economy at this point?
So if we look, it's a different way to look. If we look from a real GDP perspective, China share of global GDP is about 18%, India share about 4%. However, if we look at the purchasing power parity, basically adjusting for low price level in low-income countries like India, India share of global GDP will be 7, China still 18. So in fact, in terms of goods and services produced, if we adjust for price level, I think India GDP is still more than 2 times smaller than China, 7% of global GDP versus 18 in China.
When we look at that potential for India, though, is it placed to take that position of China, particularly as far as we look at Chinese imports? What is the structure of the Indian economy? Is it in that place to do that?
Yeah, we have looked into it in very detailed, and we came with these numbers. This are very kind of important numbers, because the question goes, can India replace China as a growth engine for the world? And very definite answer here is no. India cannot replace, and not that India won't be growing. India will be growing very fast, but starting point of India is so low that it cannot replace China. And the key variable how China or India is going to affect rest of the world is through their imports. And just a few numbers. In terms of copper, China is consuming 20 times more copper than India. In terms of aluminum consumption, China is consuming 18 times more. In terms of steel, 8 times more. And in terms of oil, 3 times more. So even if India demand for those commodities rise very strongly and China contract mildly, I think mild Chinese contraction is going to overwhelm any reasonable increase in India's demand for those commodities. And that's true for capital goods, industrial goods too.
All right, so what are you looking for then in terms of, if you, from an investor point of view, investing in India, I should say? What are the opportunities at the moment then?
I think in India, opportunities is companies that benefit from industrialization, capital spending in India. Government is directing a lot of resources into building infrastructure, and capital spending play in India are going to benefit. But for the rest of the world, it will be too small to affect companies like in Europe, Japan, that have been benefiting from China. So India at this point is not going to replace China, but there are specific bottom-up stories in India that are going to benefit from capital spending boom in India that is already underway.
And how are you seeing those valuations of those Indian companies at the moment?
Yeah, that's a kind of a weak point of investing in Indian stocks. Valuations are very expensive. Indian stocks, one of the most expensive equity market in the world. And the reason because India's story is very well known. People have been reluctant to invest in China as they've been moving money out of Chinese stocks into Indian stocks. So we're waiting for better entry point. We would not recommend buying today, but I think if there is a meaningful pullback in Indian stocks, we are going to recommend upgrading allocation to India.
So, Arthur, in terms of those emerging market equity portfolios then, how should you adjust that with your exposure in India?
I was still underweight emerging market stocks within global equity portfolio because China is huge weight and emerging market leverage to global trade, global manufacturing. As long as global trade manufacturing contracting and commodity prices are not doing that well, emerging markets will continue underperforming. So we're still waiting for better entry point. We're still remain underweight EM equities within global equity portfolio.
Arthur Budyaghyan, Chief Strategist for Emerging Markets at BCA Research. That is the global view on this Thursday. Stay with us, The Open, just around the corner.